Good morning, my friends, and welcome to today's market wrap for Saturday, June the 8th. Now, the market is basically like a bottle of soda that's been shaken up like this. Stocks and markets are moving strongly in both directions and are ready to either pop or make a huge mess. Now, before we get into all the X's and O's of everything, I think that it's important to remind ourselves how we define the market mood. Basically, I like to look at it through these three lenses here: general market, your system, and personal performance. And that gives me the traffic light of whether it's going to be red, yellow, or green. General market is what you might think. Major indexes, I take a look at the NASDAQ, S&P 500, the Russell 2000, the New York Stock Exchange, and the Dow. I look at them on daily, weekly, monthly time frames, and I also take a look at a couple of other internals out like the number of new highs versus new lows and distribution days. We'll take a look at all those things. That's the general marketplace. Then when we start to look at, well, what should we be buying? That is the system. And the way that I like to have my system is I'm looking at stocks that are growth stocks, leading stocks, stocks that have the ability to make fast moves in a relatively short period of time, that being a couple of days, couple of weeks, and for the best ones, a couple of months. I want to narrow the market down to just those, so that way I'm not looking at 10,000 stocks. I'm only looking at a couple of hundred, and then narrow that down even further, so that way each week I only have a small handful, one, two, maybe three or four that I'm actively looking to buy. And then finally, our personal performance. So if we've got this whole big funnel system to find the best opportunities in the market, if the ones that we take are doing well, that tells us something about the market. If the ones that we end up taking are not doing well and we followed all of our rules and everything, that also tells us something about the market too. So by taking a look at the market by these three lenses here, it gives us a really good look and feel into what's happening without having to listen to all the noise out there. So first off, general market. The way that I'm seeing it is continued choppiness on the daily and weekly time frames, and we'll take a look at the charts too. Continued choppiness on the daily and weekly time frames. Monthly time frames are still basically par for the course, same as what we had said last week. Distribution was drying up on the S&P and the NASDAQ. That's good. New lows ramped on Tuesday and again on Friday. So I take a look at the number of stocks that are making new 52-week highs and new 52-week lows. That is in chop land. And so that adds to that soda bottle that we saw earlier that's just been shaken up in all different directions. And I think that it'll be very helpful to take a look at the 2016 market again for some historical precedent. So let's dive into all of these charts here. So the first, daily and weekly time frames. So we have the S&P 500, NASDAQ, Russell 2000, New York Stock Exchange, the Dow, and I also like to keep the IBD 50 up because they have a lot of growth stocks in there, and it's fairly similar to what we can expect for the type of stocks that we're trading here. So I'll turn off the annotations so that way you can see the charts a little bit clearer, and you can see that the S&P 500 is near its highs. Same thing with the NASDAQ. The Russell 2000, on the other hand, trading below its 50 and started a downtrend. It undercut the recent lows, closed near its low of the day, low of the week, and it's just holding right above that thin orange line. That is the 100 EMA on this chart. And you might also take a look to the left over here and see that it's sitting right above resistance. So arguably short-term downtrend, but you might also see it as it might be moving sideways. It's getting some support here. Maybe it bounces, maybe it doesn't. Who knows? We'll find out soon enough. Over here on the NYSE, trading right around the 50-day moving average, that red line, and similar over here on the Dow. Ran up to it, got rejected as it tried to push through, and now, again, choppy action, moving sideways. Over here on the weekly time frames, similar kind of action. The S&P pushed into highs, the NASDAQ pushed into highs, the Russell trading below its 10-week line, and you're seeing that that 10-week line is starting to curve down just a little bit there. Another indication for chop. Similar action over here on the NYSE and over here on the Dow. They're very choppy waters. And then over here on the monthly time frames, we're par for the course, right? Up, up, sideways, sideways, sideways. And something else that I like to do to help visualize this is I'll track everything in a spreadsheet. So I'm manually putting this data in here. It's very easy. It takes me only a minute or two to update this sheet every single day. But I color code it, as you can see. And every time that the color changes, that's telling me that this is a change in the direction of the market. So you could see that like last week over here, we were sideways negative, then we shifted to sideways, and then it was sideways positive, then it was sideways positive again. So when it's black, that means that it's staying consistent. When it's a color, then that means that it changed direction slightly. So you can see how frequently the direction has been changing here over the past couple of weeks on the daily time frame, also on the weekly time frame, and for the most part, the monthly time frame has been steady. So if you were to picture boats in the ocean and you have a cruise ship, the cruise ships are just going straight along, and then you have the smaller yachts. Well, the smaller yachts are feeling some of the waves from the cruise ship. And you have the daily time frames. Those are your speedboats. They're just flying all over the place. It's choppy waters for them. But on that longer time frame, it's not that choppy. All right, so let's take a look at the number of stocks making new highs and new lows. We have that on this chart over here for the NASDAQ, and we'll take a look at it on the NYSE. And you can see every time that this changes color too, that's saying that now we have a streak of new highs outpacing new lows. When we have a streak of red, it means that we have a streak of new lows outpacing new highs. And when we have this black area, then that's it. You don't have a trend at all, and so it's been fairly choppy. I tracked this on that spreadsheet too, and perhaps it's a little bit more clear over here. You can see that new lows are outpacing new highs, and then over here earlier in the week, it was pretty close. New highs slightly outpacing new lows, and that's not really what we're looking for while the market is pushing into new high ground, right? If the NASDAQ is in new highs, if the S&P 500 is in new highs, wouldn't you expect to see a robust number of stocks making fresh 52-week highs? I would. Instead, well, we've got this. So that's an indication for caution. Distribution days. If you're familiar with William O'Neill's work, a distribution day is a down day on an index of at least 0.2% or more on heavier volume than the day immediately before it. It's something that he studied and showed that this is when institutional selling is coming into the market. Something that I learned from having gone through IBD's market school is that when you get a cluster of these kind of days, that it can lead to more selling, or at least more chop in the market. We had a distribution cluster in effect last week. When you get 4 or more in a 10-day span, constitutes a cluster. We haven't had distribution coming in recently. So let's go back to the chart over here where I'm actively tracking that. That gets tracked on this right here on the S&P 500, right? So you can see that that hasn't been much distribution up here at all, at least lately. Similar over here on the Dow. Now, let's go back to the spreadsheet. Actually, let's go back to the slide deck because I think that was it. Yeah, new lows ramped. We spoke about that. Let's take a look at 2016 and take a look at that price action. All right, so we'll hop over to the NASDAQ. Turn off these annotations for a minute and let's go all the way back to 2016. Right? NASDAQ pushing towards highs, right? Pushing towards those highs. You have new highs outpacing new lows, right? And then what happens in this section over here, right? You start to see new highs and new lows start to dry up. They start to level off. We've got 70s, 100 to 12. That's not bad. 57 to 24 on this day. On this day over here, 128 to 17, okay. Then you start to undercut, right? You notice the price action here. Notice how the price action is kind of choppy back and forth, back and forth. The numbers themselves are okay relative to today. But relative to its recent past, back here, where you're close to 200, back here when you're starting to get some real lift, you're in 162. Over here, 129. Very low number of new lows being made. Then over here, you're starting to taper off a bit. And you're starting to see the number of new lows ramp up ever so slightly. And then over here on this day, dramatic dry up in new highs and new lows starting to pick up. Then you start to see similar action with new lows picking up, and now you're below the 50-day moving average. This is why I look at the number of stocks making new highs versus new lows so carefully. It's because if the market is going to continuously make new high after new high after new high, it needs the stocks within it to do the same thing. And if it has a millstone around its neck, that being more and more stocks making new 52-week lows, it's going to be hard for that to happen. And so I think that this is a fairly good representation, right? And then what happens when you finally get more stocks making new highs than new lows? Oh, look what happened here. Everything started to make new highs, and we got this huge rally. This huge extended rally. So I don't know how long this is going to last, but this is where we are. So considering that, I look at the general market as being red. We don't know which direction it's necessarily going ahead. So is it the time to be stepping on the gas and going with huge size, or is it time to be a little bit more conservative since it's less clear? My opinion, time to ease off the gas a bit. Let's talk about system, right? So I'm looking for high quality growth stocks, and I put them onto a list. I call that list the universe list. That list shrank a little bit, not too much, not that big of a deal. As far as the stocks setting up within that universe list go, there are 55 setting up this week versus last week 29, so a little bit of expansion, but the quality is still mostly mediocre, still mostly B's and C's. That doesn't mean don't take any trades or that I won't personally take any trades, but I'm still not gung-ho, right? Like last week we had TWST. That one ran over 20%. We'll talk about that one a bit more in a little bit, but aside from that, there was nothing that I really liked last week. This week, nothing that I'm looking to set a working order on, but NXT does look interesting, and we'll take a look at that one. As far as the setup list as a whole, I always like to take a look and see, well, which sectors have the most setups in them, because when a lot of stocks in the same sector are setting up together, that can sometimes indicate that the group is getting ready to do something. And so in this case, software is that big group. Software sticks out like a sore thumb, right? Then we have chips, and then miscellaneous. So before we take a look at NXT and some other names, let's take a look at last week's performance. Well, last week's performance of the stocks that were setting up, only 34% of them finished positive on the week. 8 broke out, 20 consolidated, 14 broke down, and there were some pretty big moves both up and down. Let's take a quick look at those. Here's some of the names that were setting up and broke down. And so you can see that these names broke down fairly swift, right? And so that's why, too, we don't want to just trade anything that happens to be setting up or anything that's moving. We want to keep track of all the setups so that way it tells us something about the market's health. But we don't want to trade everything that happens to be moving, because a lot of it could be garbage, as we saw last week. Right? The ones that did moved fairly well. Let's take a look at some of the ones that broke out here. All right, so here's ARM. Here's Crescent Capital. Right, flip through these quickly. Here's TWST. All right, and so of all the names last week, this was the only trade that I took and added that one to the portfolio. So much of trading has to do with being patient and waiting for the right pitch to hit. Like they say, you don't have to swing at everything. Just when you see the right pitch, swing at that. This one happened to be one of those pitches. Let's go back to the slide deck, if I can find it. There it is. All right, so last week's performance. This slide looks a bit off, but basically the medical sector is the one that took off. The top performer last week was TWST. Lots of volatility in both directions. And like I mentioned a moment ago, being selective really, really pays off. So as far as the general, or as far as the system goes, that's red too, right? I happen to pick the right one, and we'll talk about personal performance in a moment. But when you're talking about your system and you're talking about the setups out there, I want to be able to close my eyes, reach into the bag, and be able to pull out a winner. In this case, if I did that, I'm probably picking out a loser. So that tells me that, you know what? It's time to be a little bit more cautious, because even if you're the best stock picker in the world, you're not going to get them all right. It's much better to start betting heavier when everything shows that, you know what, the majority of this stuff is working. When the majority of it is not working, that's when you want to start betting a little bit lighter, because the cards are not in your favor. On to personal performance. So personal performance, last 10 trades, 6 wins, no break even, 4 losses. Of my open trades, this is my performance right now. I have 4 open trades. They're all winners, and they're all doing fantastic. So personal performance-wise, it would be a green condition, right? And I'm sitting on lots of profits. All my stops are above break even. I've even taken some of those profits off the table. Now, when you're doing well, it's very, very tempting to say, all right, let's take that money, reinvest it, and start to compound a lot quicker. But if you take a look at the general market, it's not time to be stepping on the gas. You wouldn't step on the gas if you're sitting in bumper-to-bumper traffic, would you? Right? That you're not going to get anywhere fast. The only thing that you're going to get is a ticket and possibly your butt whooped by the guy that you just slammed into his rear end. So don't do that. So road ahead, it's a red condition. General market, like we said, was shook up. The system breadth is increasing, quality is still mediocre, performance is strong. It might be a nice day at the beach, but that red flag is there. You might want to test the water. Maybe if something good pops up, you can still hang out there. You don't have to dump all of your shares, but be careful out there. Bottom line, stay selective. Personally, I'll be doing smaller sizing until the market improves. That For me, that means 6.5% capital allocations with a maximum of 0.5% of capital being at risk.